There is a single number that quietly divides the world of investing into two distinct camps. It separates the perpetual anxiety of the 99% from the calm, compounding wealth of the 1%. It is the invisible force that determines whether a business is a fragile vessel tossed about by the violent seas of the economy, or a granite fortress standing immutable against the tide. This number isn't the stock price. It's not the P/E ratio. And it's not the dividend yield. It's the answer to a single, devastatingly simple question. By how much can this business raise its price tomorrow before its customers walk away? The answer to that question is the source code of financial power. Warren Buffett, over a 70-year career that has seen him navigate wars, recessions, inflation, and technological revolutions, has built an empire valued in the hundreds of billions of dollars by relentlessly focusing on this one idea. He calls it pricing power. It is the final promise a business can make to an investor, a promise of profitability that is not dictated by the market but commanded by the business itself. Most investors spend their lives on the wrong side of this equation. They buy companies that are price takers, not price makers. They invest in businesses locked in a brutal, soul-crushing race to the bottom, fighting for slivers of market share with discounts and promotions, their profit margins evaporating with every competitor's move. They are playing a game of chance, hoping that the economy stays strong, that costs stay low, that a bigger, more aggressive rival doesn't decide to bleed them dry. This is not investing. This is speculation on survival. It is the path of financial fragility, where your portfolio's growth is held hostage by forces entirely outside of your control. And it is the primary reason why so many fail to achieve true, lasting financial freedom. But a tiny fraction of businesses operate under a different set of laws. They sell a product or a service so essential, so desired, so intertwined with the customer's identity or operations that the price tag becomes a secondary consideration. These are the companies that can pass on rising costs to their customers instantly, making them functionally immune to the ravages of inflation. They are the companies that, during a recession, find their services are the last thing their customers are willing to cut. They don't just survive economic storms, they often emerge stronger as their weaker, price-sensitive competitors are washed away. Investing in these businesses is not about timing the market, it is about owning a piece of an unshakable economic franchise. It is the shift from renting stocks to owning dominant, cash-generating enterprises. This is the secret to building a portfolio that compounds relentlessly, year after year, shielded from the chaos that derails the unprepared. Today, we are not just going to talk about this principle. We are going to deconstruct it, reverse engineer it, and build a mental model from its foundational components. We will journey through the specific moments in history where this realization transformed Buffett's own strategy, examine the deep psychological triggers that make pricing power possible, and forge a practical blueprint that you can apply to your own stock picking, starting today. This is the key to unlocking a CEO mindset, to moving beyond the noise of the market and focusing on the one thing that truly drives long-term value. This is the map to the financial fortress. Our first step on this journey requires us to travel back in time to a pivotal moment in the early 1970s. It was a moment that forced a young Warren Buffett, a brilliant but still evolving investor, to confront the limitations of his own strategy. He had built his early success on a concept he learned from his mentor, Benjamin Graham, the father of value investing. It was called cigar butt investing. The idea was simple and visceral. You walk down the street and you find a cigar butt on the ground. It's soggy, it's discarded, and it's ugly, but it has one good puff left in it. You pick it up, take that final, free puff, and throw it away. In investing terms, this meant finding statistically cheap companies that were trading for less than their liquidation value. They were often terrible businesses, struggling textile mills, declining department stores, but they were so cheap that you could theoretically buy them, sell off the assets, and make a small profit. That one free puff. For years this worked. Buffett was a master at finding these cigar butts and squeezing out that last puff. But it was a grueling, unsatisfying, and ultimately limited way to build wealth. The problem with cigar butts is that you are constantly searching for the next one. The businesses never got better, they only got worse. The moment you took your puff, the asset was gone. You couldn't compound your capital inside a dying enterprise. A profound shift was necessary, and the catalyst for that shift came in the form of a box of chocolates. In 1972, a company called See's Candies came up for sale. Based in California, it was a regional chocolatier with a fanatically loyal customer base. The company was being offered to Blue Chip Stamps, a company that Buffett and his partner Charlie Munger controlled. The asking price was $30 million. The company was earning about $2 million after tax, and its net tangible assets, the factories, the inventory, the cash in the drawer, were only about $8 million. By every metric of cigar butt investing that Buffett had mastered, this was a terrible deal. He was being asked to pay a $22 million premium for something he couldn't see or touch on the balance sheet. The brand, the name, the goodwill. Buffett's initial reaction was to balk. His Graham-trained mind screamed that this was too expensive. He was anchored to the tangible book value, the cold, hard numbers. He was ready to walk away. But Charlie Munger, the intellectual partner who would prove to be the architect of Buffett's second act, saw something different. He saw the future. Munger argued passionately that they were not just buying factories and inventory, they were buying a dynasty. They were buying a deep, multi-generational emotional connection that Californians had with See's chocolate. They were buying the right to be the default choice for every birthday, every Valentine's Day, every Christmas. They were buying pricing power. Munger posed a simple thought experiment to Buffett. Imagine a young man wanting to give a box of chocolates to his girlfriend for Valentine's Day. He walks into a See's candy store. The box costs, say, $15. A generic box at the drugstore might cost $10. What is running through that young man's mind? Is he thinking about saving $5? Or is he thinking about the look on his girlfriend's face? He knows with absolute certainty that giving the See's box will be a success. It signals quality, care, and tradition. The generic box, on the other hand, signals that he is cheap. The risk of embarrassment and romantic failure is not worth the $5 savings. In that moment, the price becomes almost irrelevant. The emotional payoff is what matters. See's Candies was not selling chocolate. It was selling a guaranteed positive social outcome. Munger convinced Buffett that this intangible asset, this brand moat, was worth far more than the $22 million premium. Reluctantly, Buffett agreed. They paid the $30 million. It would become one of the most important investments of his entire life, not for its absolute size but for the profound lesson it taught him. Over the next several decades, See's Candies would generate more than $2 billion in pre-tax earnings for Berkshire Hathaway, profits that required very little additional capital investment. Every year they could raise the price of their chocolates just a little bit, and their loyal customers wouldn't even blink. Inflation would hit sugar, cocoa, labor, it didn't matter. They simply adjusted the price on the box, and the profits kept rolling in. It was a money machine, powered not by tangible assets, but by a feeling in the minds of its customers. See's Candies was the ultimate refutation of the cigar butt philosophy. It was the genesis of the modern Buffett. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The psychological principle at play in the See's Candies story is a potent combination of brand loyalty and the deeply human wiring that makes us price insensitive to things we trust. On one hand, Buffett had to overcome his own cognitive bias, anchoring. He was anchored to the low-ball valuations of his past successes, making it difficult for him to fairly assess a high-quality business. He saw the price tag of $30 million, and his brain immediately compared it to the $8 million in tangible assets, triggering a too expensive alarm. This is a trap that ensnares countless investors. They see a stock with a high PE ratio and reflexively dismiss it, without ever investigating the quality of the underlying business that justifies that premium. They are anchored to cheapness, and as the saying goes, cheap often becomes more expensive in the long run. On the other hand, See's Candies was masterfully exploiting several cognitive biases in its customers. The most powerful of these is the endowment effect. This is our tendency to overvalue something simply because we feel a sense of ownership over it. For generations of Californians, See's wasn't just a brand, it was their brand. It was part of their family traditions, their holidays, their personal history. This feeling of psychological ownership creates an emotional bond that transcends mere commerce. When you feel a brand is part of your identity, you are not just a customer, you are a supporter. A price increase doesn't feel like a corporation taking more of your money. It feels like a small price to pay to support an institution you love. This is a level of loyalty that a generic, undifferentiated product can never hope to achieve. This brand loyalty acts as an incredibly powerful filter against competitive threats. It short-circuits the rational, price-comparing part of the consumer's brain. The decision is no longer about which chocolate is the best value. The decision is simply, I need to get some C's. The consideration set has been narrowed to one. This is the holy grail for any business, and it is the foundation of true pricing power. So how do we translate this powerful insight into a practical, repeatable process for our own stock picking? We need a mental model, a blueprint for identifying businesses that operate like a private, unregulated toll bridge. A toll bridge is the perfect analogy. If you own the only bridge across a river that people must cross to get to work, you can raise the toll by 10 cents and people will complain, but they will pay. You can raise it by a quarter and they will still pay. Your business has an ironclad claim on a small portion of your customers' wallets because you provide an essential service with no viable alternative. The toll bridge mental model is a checklist of questions you must ask about any potential investment to determine if it possesses this kind of power. First, does the business have a strong, identifiable brand that commands loyalty beyond price? Ask yourself, is this product or service something people buy out of habit, tradition, or a desire for a specific, guaranteed experience? Think of brands like Apple, Harley-Davidson, or even Starbucks. People don't just buy their products, they buy into an identity. They will pay a premium for that feeling. Second, what are the switching costs for the customer? How difficult, expensive, or painful would it be for a customer to move to a competitor? Think about your bank. Moving all your automatic payments and direct deposits is a massive headache. You would likely tolerate a small increase in fees rather than go through the hassle. In the corporate world, this is even more powerful. Once a company builds its entire workflow around a piece of software, like an Oracle database or Adobe Creative Suite, the cost and risk of switching to a new system are astronomical. This creates a lock-in that gives the software provider immense pricing power. Third, does the business benefit from a lack of viable substitutes? This is the core of the toll bridge idea. See's Candies, in the context of gift-giving, had no good substitute. The generic drugstore chocolate was not a substitute, it was a social liability. Look for businesses that solve a unique problem in a way that competitors can't easily replicate. This could be due to patents, regulatory approvals, or simply a unique combination of service and quality that is difficult to match. Fourth, is there a recurring revenue component? Businesses with subscription models or frequent, repeat purchases are far more likely to have pricing power. Each small habitual transaction reinforces the customer's relationship with the brand, and small price increases are often barely noticed. Contrast this with a large, one-time purchase like a car. Customers are highly price-sensitive when buying a car because it's a major, infrequent decision where they feel compelled to shop around. A business that gets a small piece of your wallet every single month is in a much stronger position to slowly and steadily increase that share over time. By systematically running a potential investment through this four-part checklist, you begin to train your mind to look past the superficial stock price and see the underlying economic engine. You stop asking, is this stock cheap, and start asking, does this business have a license to print money? To truly appreciate the genius of this approach, we must dedicate some time to exploring its antithesis, the path of the 99%. This is the world of the commodity trap, and it is where most invested capital goes to die. A commodity business is one that sells a product or service that is virtually indistinguishable from its competitors. The only lever they have to compete on is price. Think of the airline industry. For the vast majority of travelers, a seat on a flight from New York to Los Angeles is a commodity. They don't care if the plane is painted with the logo of American, United, or Delta. They care about two things: schedule and price. This forces the airlines into a perpetual, bloody price war. If Delta lowers its fares by $50, United and American have no choice but to match it, or they will fly empty planes. Their profitability is not in their own hands. It is dictated by the most desperate or aggressive competitor in the market. This leads to a catastrophic cycle of value destruction. They have enormous fixed costs: planes, fuel, labor, gate fees, but they have no control over their revenue per seat. During good economic times, they might eke out a small profit, but the moment a recession hits or fuel prices spike, they are plunged into billions of dollars in losses. Buffett himself has famously quipped, "If a capitalist had been present at Kitty Hawk back in the early 1900s, he should have shot Orville right. He would have saved his descendants a lot of money." He invested in U.S. Air in 1989 and called it one of his biggest mistakes, even though he eventually broke even. The experience taught him a visceral lesson about the horrors of investing in a commodity business with no pricing power. The fatal flaw of the 99% investor is that they are seduced by the illusion of activity and the appearance of value in these industries. They see a beaten-down airline stock and think, "It's so cheap it has to go up." They fail to realize that it is cheap for a reason. The fundamental business economics are broken. They are buying a cigar butt, but this time, there is no final puff left. It's just ash. Investing in these companies is like trying to fill a bucket with a hole in it. Any money they make is immediately drained away by intense competition and the relentless need to spend capital just to stay in the game. This is the antithesis of the See's Candies model, where profits gush forth with little need for additional investment. The difference between these two paths manifests directly and powerfully on the financial statements of a company. This is not abstract philosophy. It is hard accounting reality. The first place to look for pricing power is the gross margin. Gross margin is calculated as revenue minus the cost of goods sold, divided by revenue. It tells you what percentage of each dollar of sales is left over after paying for the direct costs of producing the product. A company with strong pricing power, like See's Candies, will have consistently high and stable gross margins. When the cost of cocoa goes up, they simply raise the price of their chocolates, and their margin remains intact. A company in a commodity trap, like an airline, will have low and volatile gross margins. When the price of jet fuel skyrockets, they can't simply double their ticket prices, because their competitors won't. They are forced to absorb the cost, and their margins get crushed. A long-term investor should look for companies with gross margins that are not only high relative to their industry but also stable over time, through different economic cycles. The second critical metric is Return on Tangible Capital Employed, ROTC. This was Buffett's key insight from the See's deal. The company generated enormous profits relative to the $8 million in tangible assets it needed to operate. This is the hallmark of a fantastic business. It doesn't need to constantly build new factories or buy expensive equipment to grow. Its growth comes from the intangible asset, the brand, which requires very little capital to maintain. You can find this by looking at the company's operating earnings and dividing it by its net tangible assets, total assets minus goodwill and minus all liabilities. A business that can consistently generate an ROTC above 20% is likely a financial fortress. It means that for every dollar of real physical capital invested in the business, the management is generating over 20 cents of profit each year. This is the engine of compounding, and it is the direct financial consequence of having a product that customers will pay up for. This single idea, born from a box of chocolates in 1972, fundamentally rewired Buffett's approach to stock analysis for beginners and seasoned professionals alike. It was the first pillar in his cathedral of wealth, the realization that the initial purchase price is only a small part of the value equation. The true prize is owning a business with the power to dictate its own financial destiny. The second pillar of pricing power builds directly upon the first. A powerful brand is a fantastic start, but for pricing power to be truly indestructible, it must be protected by a deep and wide economic moat. A moat, in Buffett's lexicon, is a durable competitive advantage that protects a business from incursions by competitors, just as a moat filled with water protected a medieval castle. The wider and more treacherous the moat, the safer the castle's profits. There is no greater example of a business with a moat of almost mythical proportions than the Coca-Cola Company, and Buffett's investment in it in 1988 is a masterclass in identifying and capitalizing on this very principle. By the late 1980s, Buffett was already a legendary investor, but his next big move would solidify his status as a global icon of business acumen. The stage was set by one of the most infamous marketing blunders in corporate history. In 1985, facing sluggish sales and intense competition from Pepsi's Pepsi Challenge campaign, Coca-Cola's management made a fateful decision. They changed the secret formula of their flagship drink for the first time in 99 years, introducing New Coke. The public reaction was not just negative, it was one of visceral, emotional outrage. The company was inundated with tens of thousands of angry letters and phone calls. Protest groups formed. People began hoarding cases of the original formula, which became known as Coca-Cola Classic. Within 3 months, the company was forced into a humiliating retreat, reintroducing the original formula. The market and Wall Street saw this as a sign of weakness and confusion at the highest levels of a great American company. The stock languished, but where others saw chaos, Warren Buffett saw the ultimate proof of a concept. Buffett reasoned that the New Coke fiasco, far from damaging the brand, had revealed the true depth of its power. It demonstrated that Coca-Cola wasn't just a beverage, it was a permanent fixture in the collective subconscious of billions of people around the globe. It was a piece of cultural furniture. The company had tried to take something away that people felt they owned, and the reaction was ferocious. This wasn't just brand loyalty. It was a psychological territory that Coke had staked out in the human mind. Starting in 1988, Buffett began buying Coca-Cola stock. He did so aggressively, ultimately investing over $1 billion, which at the time represented more than a quarter of Berkshire Hathaway's entire portfolio. It was a massive, concentrated bet. His friends and colleagues were stunned. They saw a company in the mature, slow-growth soft drink industry that had just stumbled badly. Buffett saw a global toll bridge. He saw a business that sold its syrup concentrate for pennies, and it was then mixed with carbonated water, the cheapest of commodities, and sold for dollars in over 200 countries. He saw a product that was associated with happiness, celebration, and normalcy everywhere on Earth. He once calculated that the average person in the developed world consumed a stunning amount of liquid every day, and Coke had only a tiny fraction of that stomach share. The potential for growth was still immense. He also saw its incredible pricing power. The cost of the Coke itself is a tiny fraction of the final sale price. A restaurant can raise the price of a fountain drink by a dime, and no one notices. The bottlers can raise their prices to the supermarket, who can pass it on to the consumer, and the effect is minimal on any individual's budget. This allowed the entire Coca-Cola system to act as a brilliant inflation hedge. As costs rose, prices rose, and the profits continued to flow back to Atlanta. Buffett's $1 billion investment in Coca-Cola would, over the next decade, grow to be worth more than $13 billion. It was a monumental success that cemented the wonderful business at a fair price philosophy. He didn't just buy a company, he bought a share of the world's mind, protected by the deepest moat in business history. The underlying psychological principles that create the Coca-Cola moat are social proof and mental availability. Social proof is our innate tendency to assume that the actions of others reflect the correct behavior for a given situation. When you see Coca-Cola signs at every sporting event, in every movie, on every street corner from Des Moines to Mumbai, your brain registers it as the standard, the default, the right choice. It's the drink you see other people enjoying, and that social reinforcement is more powerful than any advertisement. The sheer ubiquity of Coke makes choosing it a frictionless, almost automatic decision. You don't have to think about it. This leads directly to the concept of mental availability, or share of mind. For over a century, Coca-Cola has spent billions of dollars not just to sell a drink, but to purchase real estate in your brain. They have associated their product with every positive human emotion: happiness, friendship, family, Christmas, summer. The goal is that when you feel the trigger, thirst, the first brand that comes to mind is Coke. When a brand achieves this level of mental availability, it no longer has to compete on price. It is competing on instinct and habit. This is a profound advantage. A competitor can offer a cheaper cola, but they cannot easily replicate the century of accumulated memories and associations that Coca-Cola has built. That is the essence of a brand moat. It is a fortress built not of bricks and mortar, but of neural pathways in the brains of billions of consumers. Breaking through that fortress is not a matter of offering a lower price. It's a matter of rewiring human psychology on a global scale, an almost impossible task. This is why, despite countless cola wars and marketing battles, Coca-Cola's market dominance has remained remarkably stable for decades. Its pricing power is a direct result of this psychological dominion. To systematically identify companies with these kinds of protective barriers, we can use a moat assessment checklist. This mental model forces us to categorize and evaluate the specific type of durable competitive advantage a business might possess. It's a crucial step in any serious stock analysis for beginners and experts alike, transforming a vague idea of a good company into a concrete evaluation of its defensibility. There are 4 primary types of moats to look for. The first is the brand moat, as exemplified by Coca-Cola or Apple. The key question here is, does the brand allow the company to charge a premium price for a product that is functionally similar to its competitors? Would a customer be willing to pay more for this brand, or even feel a sense of pride or identity in doing so? This is often found in consumer goods, where perception and status play a large role. The second type is the switching cost moat. Here, the question is, how painful would it be for customers to switch to a competitor? This is common in software, banking, and data management industries. Think of a company that uses Autodesk software for all its architectural designs. The cost of retraining every employee on a new system and converting decades of old files would be so immense that Autodesk can raise its subscription fees year after year with very little customer churn. The third is the network effect moat. This is one of the most powerful moats in the digital age. The question is, does the value of the product or service increase for each new user that joins? Think of Facebook, Visa, or eBay. A payment network like Visa is valuable because millions of merchants accept it, and millions of merchants accept it because billions of cardholders use it. This creates a virtuous cycle that is incredibly difficult for a new competitor to break into. A new payment network with only a few users and merchants has no value. The fourth type is the cost advantage moat. This can come from 2 sources: process or scale. The question is, can this company produce its product or service significantly cheaper than its rivals, allowing it to either have higher margins or win on price? A process advantage might come from a unique, patented manufacturing technique. A scale advantage like that of Walmart or Amazon comes from being so large that they can negotiate better prices from suppliers and operate with a logistical efficiency that smaller competitors simply cannot match. By using this checklist, an investor can move beyond simple financial metrics and begin to understand the qualitative, structural advantages that allow a company to defend its profitability and exert pricing power over the long term. The opposite of investing in a moated fortress is falling into the fad trap. This is the path of the 99% who chase momentum without understanding sustainability. A fad business is one that enjoys a temporary surge in popularity and sales, often leading to a soaring stock price, but lacks any underlying durable competitive advantage. These companies look invincible on their way up, but their success is built on sand. Think of companies like Crocs in its first iteration, or GoPro. For a brief period, these products were everywhere. The companies enjoyed explosive growth and, for a moment, seemed to have pricing power, but their moats were non-existent. Crocs were a fashion item, and fashion is fickle. Once the novelty wore off, cheap knockoffs flooded the market, and the company's sales and stock price collapsed. GoPro created an entirely new category of action cameras, but they had no way to prevent competitors like Sony or even smartphone makers from entering the market with similar or better products. They had no brand loyalty that could command a permanent premium, no switching costs, and no network effects. The result was a brutal price war and a massive destruction of shareholder value. The retail investor is particularly susceptible to the fad trap. They see a product becoming popular, they see the stock rising, and they experience a powerful fear of missing out. FOMO. They pile in at the peak, mistaking temporary popularity for a permanent moat. They fail to ask the critical questions from the moat assessment checklist. They don't look for the structural protections. When the fad inevitably fades, they are left holding a stock that may never recover. This is a critical distinction for anyone seeking to achieve long-term portfolio growth. You must learn to differentiate between a short-term trend and a long-term franchise. A franchise is a castle with a moat. A fad is a tent in a hurricane. The financial connection between a strong moat and superior investment returns is profound and operates on two levels. The first and most obvious is the predictability of earnings. A company with a wide moat like Coca-Cola has a much more stable and predictable stream of future earnings than a company in a brutal competitive industry. This stability is incredibly valuable. It reduces the risk of the investment and allows an investor to forecast the company's future cash flows with a much higher degree of confidence. The market recognizes this predictability and rewards it. This leads to the second, more powerful effect: multiple expansion. The multiple, often expressed as the price-to-earnings (PE) ratio, is simply the price the market is willing to pay for $1 of a company's earnings. A shaky, unpredictable, no-moat business might trade at a PE ratio of 8. A dominant, moated fortress with predictable growth might trade at a PE ratio of 25. Let's consider two companies, both earning $1 per share. Company A is a no-moat business and its stock trades at $8, a PE of 8. Company B is a moated fortress and its stock trades at $25, a PE of 25. Over the next 5 years, both companies managed to grow their earnings to $2 per share. The stock of Company A, still seen as risky, might continue to trade at a PE of 8, meaning its stock price would rise to $16. That's a 100% return, which is not bad, but Company B, with its predictable growth, maintains its premium PE of 25. Its stock price would rise to $50. That's also a 100% return. However, the magic happens when the market begins to recognize that a company is transitioning from a no-moat to a wide-moat business. Imagine a third company, Company C, which also earns $1 per share and is initially viewed as risky, trading at $8, a PE of 8. But over the next 5 years, it builds a powerful moat, and its earnings grow to $2 per share. Now, the market recognizes its quality and rewards it with a higher multiple, say a PE of 20. Its stock price would not just go to $16, it would go to $40, $2 in earnings times a PE of 20. This is a 400% return. This is the dual engine of capital gains that Buffett seeks, the combination of growing earnings and a growing multiple as the market recognizes the company's superior quality. This is how multi-billion-dollar fortunes are built. It's not just about finding growing companies. It's about finding companies that are building moats, thereby securing their ability to exert pricing power and command a premium valuation from the market. This is a cornerstone of any sophisticated wealth management strategy. The third pillar supporting the fortress of pricing power is the concept of indispensability. A business's ability to raise prices without losing customers is magnified exponentially when its product or service is not just desired, but is deeply and inextricably woven into the fabric of its customer's life or business operations. It's the difference between a nice-to-have and a must-have. When a product becomes non-negotiable, price becomes a mere detail. To understand the sheer force of this principle, we must go back to one of Buffett's earliest and most daring investments, a bet that he made in the 1960s that was so large and so concentrated, it could have destroyed his young partnership. This was his investment in American Express during the infamous salad oil scandal. In 1963, American Express was a respected company, known primarily for its travelers' checks and its relatively new charge card. However, a significant but obscure part of its business was a warehousing division. This division would inspect and certify inventory in warehouses and then issue receipts against that inventory, which other companies could then use as collateral for bank loans. One of its biggest clients was the Allied Crude Vegetable Oil Refining Company, run by a man named Tino DeAngelis. DeAngelis was a fraud. He had filled his massive storage tanks in Bayonne, New Jersey, mostly with seawater, with only a thin layer of valuable soybean and cottonseed oil floating on top. He used the fraudulent warehouse receipts from American Express's subsidiary to secure over $150 million in loans from dozens of banks. When the fraud was discovered, Allied Crude went bankrupt, and the banks, holding worthless receipts, turned to American Express demanding to be made whole. Wall Street panicked. The potential liabilities were enormous, far exceeding American Express's net worth. The conventional wisdom was that the company was headed for bankruptcy. The stock price was obliterated, plummeting by more than 50% in a matter of weeks. This was a crisis of existential proportions. While the rest of the market was consumed by fear and dumping the stock, the young Warren Buffett saw an opportunity. He understood that the market was making a classic mistake. It was focusing entirely on the balance sheet liabilities of one troubled division and completely ignoring the powerful, intangible franchise of the core business. So, he did what he always does. He went out and did his own primary research. He didn't just read reports, he observed human behavior. He went to restaurants and travel agencies. He talked to merchants. He stood on the street corner and watched people. And what he saw was the key to the entire puzzle. He saw that customers were still using their American Express cards. He saw that travelers were still buying American Express travelers' checks without hesitation. The merchants he spoke to confirmed it. Business was as usual. Why? Because the salad oil scandal, while a disaster for the warehousing division and a headache for the lawyers, was an abstract headline to the average cardholder or business owner. What was not abstract was the utility and status of the American Express brand. For the business traveler, the card was an indispensable tool for managing expenses. For the affluent consumer, it was a status symbol. For the merchant, accepting the card was a non-negotiable cost of doing business to attract high-spending customers. The core payment system was so deeply embedded in the commercial life of its users that a scandal in a completely unrelated division was irrelevant to its continued function. Buffett realized that the American Express brand and its payment network constituted an economic moat of immense strength. The company's customers were not going to stop using the service because of Tino DeAngelis's fake salad oil. The franchise was intact. Convinced of this, Buffett made an audacious move. He invested 40% of his partnership's capital, a sum of $13 million, into American Express stock. It was a massive bet-the-farm decision. Within 2 years, as the company settled the legal claims for far less than feared and the core business continued to thrive, the stock price had quintupled. The investment was a grand slam that launched Buffett into the major leagues of finance. The lesson was indelible. When a business is truly indispensable to its customers, it can withstand almost any storm, and its pricing power is at its most potent. The psychological drivers behind indispensability are loss aversion and status quo bias. Loss aversion, a concept pioneered by psychologists Daniel Kahneman and Amos Tversky, describes our tendency to feel the pain of a loss about twice as strongly as we feel the pleasure of an equivalent gain. When a product or service becomes integral to our daily routine or business operations, the thought of losing it triggers this powerful aversion. Imagine your company runs on Microsoft Office. The idea of switching to a different Office suite is not framed in your mind as, maybe we could gain some new features. It's framed as, we would lose all our existing files, our employees would have to be retrained, our workflows would be destroyed. The perceived loss is so great that it makes the decision to switch almost unthinkable. This gives Microsoft the power to increase its subscription fees for Office 365, because the cost of paying a little more is vastly outweighed by the perceived pain of leaving. This is amplified by status quo bias, which is our natural preference for the current state of affairs. Change is effortful and risky. Sticking with what we know is easy and feels safe. A company that provides an indispensable service becomes the status quo. To dislodge it, a competitor can't just be slightly better or slightly cheaper. It has to be so spectacularly superior that it overcomes the powerful psychological inertia pulling the customer to stay put. This is a monumental barrier to entry. Companies that have successfully made their products indispensable, think of Google for search or Amazon Web Services for cloud computing, are not just selling a service, they are selling certainty and stability. And for that, customers are willing to pay a premium, insulating the business from the price wars that plague sellers of non-essential goods. To apply this insight, we can use a mental model called the indispensability test. This is a set of rigorous questions to determine just how critical a company's product is to its customers. It helps separate the true financial fortresses from the businesses that are merely popular. First question: what would happen to the customer's life or business if this product disappeared tomorrow? Describe the chaos. Would it be a minor inconvenience or a catastrophic failure? If a social media app disappears, users are annoyed for a week and then move to the next one. If a company's cloud hosting provider disappears, the entire business ceases to exist. The level of chaos is directly proportional to the company's pricing power. Second question: how does the cost of the product compare to the value it provides or the cost it saves? This is the concept of a high-value proposition. Think of a credit rating agency like Moody's. A large corporation might pay Moody's a few $100,000 to rate its bonds. That fee is a tiny, almost insignificant fraction of the billions of dollars the corporation is trying to raise. A favorable rating from Moody's can save the corporation tens of millions of dollars in interest payments. Because the cost of the rating is so small relative to the value it provides, Moody's has enormous pricing power. They can raise their fees substantially without the customer even thinking of walking away. Third question: is this a painkiller or a vitamin? A vitamin is a nice-to-have. It might offer some benefits, but you can live without it. A painkiller solves an urgent, acute problem. You would pay almost anything to make the pain go away. Invest in painkillers. A company that sells a tool that helps businesses comply with complex tax regulations is a painkiller. The pain of non-compliance, fines, audits, jail time, is so severe that customers will gladly pay for the solution. A company that sells a productivity app that promises to make your team more synergized is a vitamin. It's easily discarded when budgets get tight. Applying the indispensability test is a powerful filter that forces you, as an investor with a CEO mindset, to focus on the economic reality of a business from the customer's point of view. The antithesis of an indispensable business is one caught in the discretionary purchase dilemma. These are companies that sell non-essential goods and services that are easily postponed or substituted when times get tough. This category includes a vast swath of the economy: mid-range restaurant chains, fashion apparel retailers, cruise lines, furniture stores. During a strong economy, these businesses can do very well. Consumers have disposable income and are happy to spend it. But the moment a recession looms, or an individual faces personal financial pressure, these purchases are the very first things to be cut from the budget. You can put off buying a new sofa. You can cook at home instead of eating out. you can postpone a vacation. The key vulnerability of these businesses is their complete lack of pricing power when it matters most. Trying to raise prices during a downturn is a suicidal move. In fact, they are often forced to do the opposite, engaging in deep discounting and promotions just to get customers in the door. This crushes their margins at the worst possible time, often leading to losses and bankruptcies. The 99% investor is often drawn to these stocks after they have been beaten down, seeing them as turnaround plays. They mistake the cyclical nature of the business for a temporary problem. They fail to appreciate the fundamental weakness. When your product is a want and not a need, you are always at the mercy of the economy. You have no control over your own destiny. An investment in a discretionary business is a bet on the macroeconomy. An investment in an indispensable business is a bet on the enduring power of a specific business franchise, a much safer and more profitable proposition for the long-term investor seeking true building wealth. The financial proof of indispensability is found in two key metrics: low customer churn and a high ratio of lifetime value (LTV) to customer acquisition cost (CAC). Customer churn is the rate at which a company loses its customers. A business selling an indispensable product will have extremely low churn. Its customers stick around year after year, not because of aggressive marketing, but because the product is essential. This creates a stable, recurring revenue stream that is highly predictable and very valuable. You can see this in the quarterly reports of software-as-a-service SaaS companies, which often report a net revenue retention rate. A rate over 100% means that the company is not only keeping its existing customers but is also selling them more services over time, the ultimate sign of an indispensable relationship. This leads to the LTV/CAC ratio. LTV is the total profit a company can expect to make from a single customer over the entire course of their relationship. CAC is the cost of acquiring that new customer, marketing, sales, etc. A great business with an indispensable product might spend $1,000 to acquire a new customer, but that customer will generate $10,000 in profit for the company over their lifetime, an LTV/CAC ratio of 10 to 1. A weak discretionary business might spend $1,000 to acquire a customer who only makes one or two purchases and generates just $1,200 in profit, a ratio of 1.2 to 1. The company with a high LTV/CAC ratio has a vastly superior business model. It can afford to spend more on growth because each new customer is a long-term profit annuity. This is the financial architecture of market dominance. Identifying businesses with this characteristic is a core strategy for achieving financial freedom, as you are essentially buying a stream of future cash flows that is protected by the wall of indispensability. The fourth pillar of the pricing power fortress is a concept that seems, at first, paradoxical. It is the principle of capital-light compounding. The most powerful businesses in the world are those that can grow their earnings and exert their pricing power without having to constantly reinvest massive amounts of capital back into the business just to stay competitive. They are cash-gushing machines, where profits flow freely to the owners rather than being perpetually consumed by the needs of the enterprise. This might seem to contradict some of Buffett's largest investments, none more so than his 2009 acquisition of the Burlington Northern Santa Fe (BNSF) Railway. On the surface, a railroad is the quintessential capital-heavy business. It requires enormous investment in tracks, locomotives, bridges, and tunnels. It looks like the exact opposite of a capital-light enterprise. And that is why Buffett's decision to buy the entire company for $44 billion, his largest acquisition ever at the time, was so instructive. He made this move in the darkest depths of the great financial crisis, a time of profound economic fear. Many observers saw it as a bet on an archaic 19th-century industry. But Buffett, as always, saw a different reality. He saw an irreplaceable asset that formed the very circulatory system of the American economy. BNSF is one of only two major railroads that control the entire western United States, creating a powerful duopoly with Union Pacific. If you need to ship massive quantities of grain from the Midwest, coal from Wyoming, or consumer goods from the Port of Los Angeles, you have very few choices. You have to use the railroad. This structural advantage gives BNSF immense and durable pricing power. The key insight Buffett had was to distinguish between maintenance capital expenditures and growth capital expenditures. Yes, a railroad has to spend billions every year just to maintain its existing network, replacing rails, servicing locomotives. This is the cost of doing business. However, the incremental tom profit on each additional railcar that travels on that already built network is enormous. Once the track is laid from Chicago to Los Angeles, the cost of adding one more container train is very small, but the revenue it generates is substantial. BNSF doesn't need to build a whole new transcontinental railroad to grow. It grows by increasing the volume and the price of the goods moving over its existing, irreplaceable network. In this sense, its growth is capital light. Buffett saw BNSF not as a static, heavy asset, but as a toll bridge on American commerce, one that would benefit directly from the long-term growth of the U.S. economy. He famously called the acquisition an all-in wager on the economic future of the United States. He knew that as the country grew, more goods would need to be moved, and BNSF would get its toll. The pricing power is baked into the system. Railroads can implement annual price increases that are typically above the rate of inflation, and their customers have little choice but to pay. They are far more efficient than trucking for moving heavy goods over long distances, making them the indispensable choice for many industries. The BNSF acquisition was a masterstroke, teaching a crucial lesson. The quality of a business is not determined by how much capital it employs, but by the return it generates on that capital. A well-positioned, moated, capital-intensive business can be a far better investment than a capital-light business with no competitive advantage. The psychological hurdle that prevents most investors from understanding this is a form of cognitive dissonance. The mind struggles to hold two conflicting ideas at once. The common heuristic is, capital-intensive equals bad business. When presented with an investment like a railroad, this mental shortcut flashes a warning sign. It takes a more sophisticated level of thinking, a CEO mindset, to look deeper and differentiate. Buffett overcame this by focusing not on the absolute amount of capital required, but on the turn on incrementally invested capital. This is the crucial distinction. He asks, if I put $1 more of capital into this business, how many cents of profit will it generate for me year after year? For a business like BNSF, that incremental return is very high. For a struggling competitive business, that extra dollar of capital might generate only a few cents of profit or none at all. The average investor is often repelled by the complexity and perceived ugliness of industrial businesses. They are drawn to the shiny, new, asset-light tech companies. Sometimes this is correct, but often they fail to appreciate the durability and pricing power of the old-world giants that form the economy's backbone. It requires a mental leap to see the beauty in a balance sheet laden with property, plant, and equipment, but only if those assets form a strategic fortress that locks out competition and allows for profitable growth. To operationalize this principle, we must use Buffett's own metric, the owner earnings calculation. This mental model is designed to cut through the distortions of formal accounting and arrive at the true, cash-generating ability of a business. Buffett first laid out this concept in his 1986 letter to shareholders, and it is perhaps his most important contribution to the field of security analysis. The formula is, owner earnings equals net income plus depreciation and amortization, average annual maintenance capital expenditures. Let's break this down. We start with net income, the bottom line profit from the income statement. We then add back depreciation and amortization. These are non-cash charges that accounting rules require companies to take, but they don't represent an actual cash outlay. The final and most important step is to subtract maintenance capital expenditures, or maintenance CapEx. This is the tricky part. Maintenance CapEx is the amount of money the company has to spend each year just to keep its current operations running. To stand still. It's the cost of replacing old machines or fixing worn-out tracks. This number is not explicitly stated in financial reports, so it requires some estimation. A good rule of thumb is to look at the company's total capital expenditures over a full business cycle, say 7 to 10 years, and try to determine what portion was used for new projects and expansion versus what was used just to maintain the existing asset base. The resulting owner earnings figure represents the true cash profit that is available to the owners of the business at the end of the year. This cash can be used to pay dividends, buy back stock, or make acquisitions. A business with high owner earnings relative to its market price is a cash-generating machine. This calculation reveals the truth behind the numbers. It allows an investor to see which companies are truly gushing cash and which ones are running on a capital-intensive treadmill, where all their reported profits are immediately consumed by the need to replace aging equipment. This is a core tool for any retail investor who wants to adopt a professional, long-term investing approach. The antithesis of a capital-light compounder is a business stuck in a capital expenditure black hole. These are companies that operate in highly competitive, technologically dynamic industries where they are forced to spend enormous sums of money year after year just to keep up with their rivals. The airline industry is again the perfect example. An airline must constantly buy new, more fuel-efficient planes. This is not optional. If they continue to fly old, inefficient planes while their competitors upgrade, their cost structure will become uncompetitive, and they will be driven out of business. But here's the trap. Spending billions on a new fleet of planes doesn't give them any lasting competitive advantage. Their competitors are doing the exact same thing. So they spend massive amounts of capital, but it doesn't improve their pricing power or their long-term profitability. The money is simply incinerated in the furnace of competition. Other examples include many semiconductor manufacturers or auto companies, which are locked in a constant arms race of research and development and factory upgrades. They report profits, but when you perform the owner earnings calculation, you often find that after subtracting the massive maintenance capex, which in these industries is almost all of their capex, there is very little cash left over for shareholders. The 99% investor is often lured in by the growth stories of these companies. They see the new products, the expanding factories, and they mistake activity for progress. They fail to see that the company is like a hamster on a wheel, running faster and faster just to stay in the same place. This is a primary cause of portfolio underperformance and a failure to build real wealth over time. The direct financial connection here is arguably the most important single metric in all of investing: return on invested capital, ROIC. ROIC measures how efficiently a company is using all the capital it has, both debt and equity, to generate profits. It is calculated as the company's net operating profit after tax divided by its total invested capital. A company with a high and sustainable ROIC is a compounding machine. A company with pricing power and a capital-light growth model will naturally have a very high ROIC. It can generate a lot of profit from a relatively small capital base. Let's illustrate with an example. Company A has an ROIC of 25%. Company B has an ROIC of 5%. Both companies earn $1 million this year and decide to retain all of it to reinvest in the business. Company A, with its 25% ROIC, will turn that $1 million reinvestment into an additional $250,000 of profit next year. Company B, with its 5% ROIC, will turn that same $1 million into only an additional $50,000 of profit. Now, project that out over 20 years. The difference is not linear, it is exponential. The high ROIC business will have compounded into a financial behemoth, while the low ROIC business will have stagnated. This is the magic of compounding that Buffett so often talks about. But the magic only works if the business can reinvest its earnings at a high rate of return. A high ROIC is the ultimate financial signature of a great business with a durable competitive advantage and strong pricing power. It is the number that separates the businesses that create wealth from those that destroy it. Mastering the ability to identify high ROIC businesses is a non-negotiable skill for anyone serious about asset allocation and portfolio growth. The fifth and final pillar is the one that holds the entire structure together. A business can have a powerful brand, an impregnable moat, an indispensable product, and a capital-light model, but all of it can be rendered worthless by poor leadership. The leadership linchpin is the recognition that pricing power and a great economic franchise are assets that must be managed with rationality, integrity, and a relentless focus on shareholder value. Without the right management team at the helm, even the greatest business castle can be flooded from within. The perfect illustration of this principle is Buffett's long and fruitful investment in the Washington Post Company and his legendary partnership with its leader, Katharine Graham. In 1973, Buffett began buying stock in the Post. At the time, the company was a collection of assets, including Newsweek magazine and several television stations, but its crown jewel was the Washington Post newspaper. In the 1970s, a major city newspaper was one of the greatest economic franchises imaginable. In most cities, including Washington, D.C., the Post had a virtual monopoly. If a local business wanted to advertise, if someone wanted to check the movie times, if a family wanted to place a classified ad, they had to go through the Post. It was the indispensable information hub of the city. This gave it enormous pricing power. They could raise their advertising rates year after year, and businesses had no choice but to pay. The newspaper was a classic toll bridge with a deep moat. But Buffett knew that a great asset was not enough. The stock was cheap, trading at a valuation that was less than a fifth of what he believed the assets were worth. Why? Because Wall Street was skeptical of its management, led by Katharine Graham. Graham had been thrust into the CEO role after the tragic death of her husband. She was initially seen as an inexperienced socialite in a male-dominated industry. Furthermore, the newspaper industry was facing powerful and aggressive labor unions. Many other newspaper owners had caved to union demands, leading to bloated cost structures that eroded their profitability. Buffett saw two things. First, he saw the unshakable quality of the asset. Second, after meeting her, he saw in Katharine Graham a leader of immense intelligence, courage, and integrity. He invested heavily and soon took a seat on the board of directors, where he became her close friend and advisor for decades. It was the combination of the great asset and the great manager that unlocked the value. Guided by Buffett's principles of rational capital allocation, Graham made a series of brilliant decisions. She took a tough stand against the unions during a debilitating strike in 1975, a move that was risky but ultimately secured the paper's long-term financial health. She resisted the temptation that plagued so many other media executives to engage in diversification, using the cash from the core business to buy unrelated, mediocre companies at inflated prices. Instead, under Buffett's tutelage, she used the newspaper's gushing cash flows to buy back huge amounts of the company's own stock at times when it was trading at a discount. The single act of intelligent capital allocation was enormously valuable, as it increased each remaining shareholder's ownership stake in the wonderful underlying business, without spending a dime on a risky new venture. The Washington Post investment was a monumental success for Berkshire Hathaway, turning an initial $10 million investment into over $1 billion. It was the ultimate proof that pricing power is a powerful weapon, but it requires a rational and shareholder-focused general to wield it effectively. The psychological trap that this pillar helps us avoid is known as the principal-agent problem. In corporate finance, the shareholders are the principals, the owners, and the management team, including the CEO, are the agents, hired to act in the owner's best interests. The problem is that the interests of the agents are not always aligned with the interests of the principals. A CEO's ego and compensation might be tied to the sheer size of the company they run. This can lead to what Buffett calls the institutional imperative, a tendency for managers to mindlessly imitate their peers and engage in empire building, regardless of whether it creates shareholder value. A CEO might be tempted to use the company's cash to make a big, splashy acquisition, even an overpriced one, because it generates exciting headlines, increases the company's revenue, and justifies a bigger salary for the CEO. This is often disastrous for the shareholders, who see their ownership diluted and their capital squandered on a low-return project. Buffett's genius lies in his ability to assess the character and mindset of a CEO to determine if they are truly acting like a partner owner or like a self-interested agent. He reads their annual letters to shareholders, looking for candor and transparency. He looks at their track record of capital allocation. Do they buy back stock when it's cheap? Do they pay dividends when there are no good reinvestment opportunities? Or do they hoard cash and then blow it on a foolish acquisition at the top of the market? A management team that thinks like a principal is a priceless asset. A management team that succumbs to the principal-agent problem can destroy even the best business. To systematically evaluate the quality of a company's leadership, we can use a management quality scorecard. This mental model provides a checklist for judging whether a management team is likely to be a creator or a destroyer of long-term value. There are 3 key areas to score. First, rational capital allocation. Look back at the company's history of major financial decisions over the past decade. How did they use their free cash flow? Did they make large acquisitions? If so, were they in related businesses and at reasonable prices? Did they issue a lot of new shares, diluting existing owners, or did they consistently repurchase shares, concentrating ownership? A track record of disciplined, value-creating capital allocation is the single most important sign of a great management team. Second, candor and transparency. Read the CEO's last 5 annual letters to shareholders. Is the language clear, direct, and honest? Does the CEO openly discuss the company's mistakes and challenges, or is it all corporate jargon and happy talk? A CEO who communicates with their shareholders like they are intelligent business partners, as Buffett does, is a CEO you can trust. A CEO who obfuscates and spins is a major red flag. Third, shareholder-aligned incentives. Look at the company's proxy statement and examine how the top executives are compensated. Is their bonus tied to metrics that actually create long-term value, like growth in owner earnings per share or return on invested capital? Or is it tied to vague, easily manipulated metrics like adjusted EBITDA or simply the short-term stock price? You want to see incentives that reward executives for making the whole pie bigger for everyone over the long run, not for hitting short-term targets that might encourage reckless behavior. Using this scorecard transforms the fuzzy concept of good management into a concrete, evidence-based assessment, a critical skill for entrepreneurs and investors who seek market-beating returns. The antithesis of a shareholder-focused leader is the empire-building CEO. This is the manager who is driven by ego, hubris, and a desire to preside over the largest possible enterprise. They are addicted to the deal and view growth, any growth, as an unalloyed good. The historical graveyard of business is filled with the monuments to their folly. The most infamous example is the 2000 merger of AOL and Time Warner. At the peak of the dot-com bubble, AOL, the hot internet company, used its massively inflated stock to acquire Time Warner, the old media titan, with a collection of world-class assets like Warner Brothers, HBO, and Time magazine. The deal was hailed by its architects as the creation of a new media superpower. It was, in fact, an act of breathtaking value destruction. The cultures clashed, the promised synergies never materialized, and the dot-com bubble burst, vaporizing AOL's valuation. The combined company would go on to report a loss of nearly $100 billion in 2002, the largest in U.S. corporate history at the time. The CEOs who orchestrated this disaster were classic empire builders. They were seduced by the grand vision, the cover of Fortune magazine, and the desire to create the biggest company in the world. They paid little attention to the price they were paying or the practical realities of integrating 2 vastly different businesses. For shareholders, the result was a decade of pain and a stock price that was decimated. The 99% investor often gets swept up in the excitement of these mega mergers. They listen to the CEO's grand pronouncements and buy into the hype. The disciplined investor, armed with the management quality scorecard, learns to be deeply skeptical. They know that more often than not, large acquisitions destroy value, and that true long-term growth is usually organic, patient, and built on the foundation of a great underlying business. The financial connection here is the direct and dramatic impact of capital allocation decisions on long-term shareholder returns. Let's consider two identical companies, Fortress Inc. and Empire Corp. Both are wonderful businesses with strong pricing power, each generating $1 billion of free cash flow per year. The stock of both companies currently trades at a price that represents a 10% free cash flow yield. The CEO of Fortress Inc. is a rational capital allocator. Seeing that the company's own stock is a very attractive investment, offering a 10% return, she decides to use the entire $1 billion of cash flow to buy back shares. This reduces the number of shares outstanding by 10%. As a result, next year's earnings per share will be more than 11% higher than they would have been otherwise, even with no growth in the underlying business. The CEO of Empire Corp., on the other hand, is an empire builder. He uses his $1 billion to acquire a mediocre company in an unrelated industry, paying a high price that results in a measly 5% return on his investment. He has grown the empire, but he has taken $1 billion that was earning 10% in the form of his own company's cash flow yield and redeployed it into an asset earning only 5%. He has actively destroyed shareholder value. Now, compound these decisions over 10 years. The CEO of Fortress Inc. will have dramatically increased the per-share value of the business for the remaining owners. The stock price will have soared. The CEO of Empire Corp. will have created a bloated, inefficient conglomerate with mediocre returns. The stock price will have stagnated. The underlying business was the same, but the leadership made all the difference. This is why the leadership linchpin is the final and most crucial element. Pricing power creates the prize money, but it is the skill and integrity of the capital allocator that ensures the money ends up in the shareholders' pockets. You have just spent this time absorbing a powerful and transformative mental framework. You have fundamentally rewired the way you will look at any business or investment for the rest of your life. You've moved beyond the flickering noise of day-to-day stock prices and have acquired the lens of a true business owner, the lens that Warren Buffett has used to systematically identify the most dominant financial fortresses in the world. You now understand that the secret to building lasting wealth and achieving true financial freedom isn't about finding what's cheap, it's about finding what is powerful. You have the blueprint for identifying pricing power, the single most important promise a business can make to its investors. This tool is now a permanent part of your intellectual arsenal. But what you must understand is that this tool, as powerful as it is just one component in a much larger, interconnected system of thought. Buffett's mind is not a collection of isolated tricks. It is a latticework of mental models that support and reinforce one another. The principle of pricing power is one type of economic moat, a brand or utility moat. But there are other moats, equally powerful, that create different kinds of financial fortresses. There are businesses protected by network effects, where every new user makes the service more valuable for all the others. There are businesses protected by high switching costs, which lock customers in through sheer inertia and pain of leaving. Understanding this entire ecosystem of competitive advantage is the next crucial step in your journey. The video that is now appearing on your screen is not an accident. It is the missing link. It is the piece of the map that connects the principle you have just mastered to the broader strategy of identifying all the different kinds of economic fortresses that exist in the market. It builds on the foundation we have laid here today, taking you from understanding one pillar of power to understanding the entire architecture of market dominance. The choice you have now is a simple one. You can stop here, with one powerful tool in your belt, or you can continue your ascent. You can choose to be someone who has learned a tactic, or you can commit to becoming someone who masters the entire strategy. The click you are about to make is not just about watching another video. It is a decision about the kind of investor you want to become. It is the next step in completing your mental arsenal and claiming your own financial independence. Continue the journey. Complete the map.